Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at Goodwill. I'm going to, as always, give you the definition in this video and then show you a little example here and a little history and let you know what you need to know about it, okay? Goodwill is a long-term asset account categorized as an intangible asset. Goodwill arises when one company acquires another entire business. When the purchase price is greater than the fair market value of the net tangible assets of the company being bought, the excess is considered goodwill and shows up on the acquiring company's balance sheet. The amount in the Goodwill account will only be adjusted as of now to a smaller amount if there is an impairment in the value of the acquired company. Companies test for this impairment annually. I say as of now because it used to be different, but we'll get to that in a minute. All right, let's go look at an example. Okay, here we are looking at the balance sheet for Bank of America. You can see it right here. And on the balance sheet is where you're going to find Goodwill. You'll remember, if you've watched our previous videos covering the balance sheet items such as assets, you know that they are listed in their order of liquidity. And the first set on the asset list are the quick assets, or those assets which can be liquidated within 12 months. And then the longer term assets, the second set, are those that take longer than 12 months to liquidate. And as you move down the list here, you'll come across Goodwill. So let me pull this down so you can see this. Alright, so here's your Goodwill right here, and you can see that in fact Bank of America does have a reported Goodwill there. That tells us one thing. It tells us that in fact they have gone out and bought entire other companies and paid more than their fair market value of their net tangible assets when they bought those companies, and that amount that was paid over, known as blue sky or Goodwill, is currently at 69.9. Okay, so we know that they have in fact done this. Now it used to be, and let me give you a little bit of history here. It used to be, well, the rule was FAS 142. It's an accounting rule that changed the way companies treat Goodwill. Prior to December 2001, companies who chose to report Goodwill had to amortize the Goodwill over the course of 40 years, which would require the company to negatively impact their earnings as they started to write this down, so to speak. Because of that negative effect on earnings for many companies, they chose not to report Goodwill, opting instead the method of what's known as pooling interest or combining like interest, which is basically combining two balance sheets, creating two major problems though. First, the Goodwill was not reflected, and therefore the financial statements did not reflect the true value of the acquiring company. Second, when Goodwill is not reported, some management teams having no real accountability would just pay ridiculous prices for companies they wanted to acquire, knowing that they would not have to report the Goodwill. FAS 142 corrected that issue, and now companies must report Goodwill. However, they do not have to amortize the Goodwill unless there is an impairment. An impairment of Goodwill is basically badwill. Let's say that you are a major company out there and you're running the show, and you go out there and you purchase another company, and then that company does something stupid and somehow harms that Goodwill. They have either have angered their customer base or something of that nature. Well, then you'd have to write down or amortize that Goodwill. And you can see in this particular case, looking at the balance sheet of Bank of America, if we scroll over a little bit here, move over here, you can see, and get the tools, magical tools. Alright, there they are. Alright, you can see right here, and where's it, 86, dropped next year to 73, next year to 69. Not a big surprise in the current market environment, being looking at financials, and they were obviously acquiring other financial companies. It doesn't surprise me that they've been doing that. That's something else that you should take note of when you're looking at your different financial companies or any company that you're looking at. Always analyze the balance sheet to see the Goodwill reported there. Now, not every company is going to have Goodwill, but those that do, you want to know how much are they paying above the fair market value of their net tangible assets for those acquired companies. If they're paying god-awful amounts above that, well then in effect the management is simply ripping you off because they're using your money to pay far greater prices than they should be paying. Now remember that Goodwill is seen as an intangible asset on the balance sheet because it's not a physical asset like a building or a piece of equipment. Goodwill reflects the value of intangible assets, such as a strong brand name, good customer relations, good employee relations, secret formulas, that type of thing. Being that you can create Goodwill by paying greater than fair market value of their net tangible assets, you can also create what's known as negative Goodwill. If you are able to buy another company for a price less than the fair market value of their net tangible assets, that would create a negative Goodwill, and you can also see that show up on your financial statements. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.